Good evening, ladies and gentlemen. Welcome back to episode 5 of the Australian Gold Weekly Review. My name is Ved Shah and I'm your host. And joining me today is the managing partner at Gold Hub Australia, Mr. Brian Chu.
Hi, Ved. How are you going?
Good, Mr. Brian. How are you? How's your week been so far?
It's been a good one. Gold's done very well, and we're going to talk a bit more about why. And gold stocks have also broken new records, not all of them. And there are interesting things happening. We are in the month of September, 2 weeks from the potential rate cut for the Federal Reserve. And same time last year, that actually sent gold stocks on another rally. I look forward to the possibility of that happening. It looks like the market's already geared up for it. That's something which we're going to be talking about next.
Right. Exciting things coming up ahead for gold. And when I say that, that can potentially mean within the next hour as well, because for the last 2 videos, the moment we've stopped recording, gold prices have managed to soar up. So we've got interesting things coming up for gold for sure at the September 16-17 meeting, where the Fed is expected to cut rates. But within the next 45 minutes to an hour, can we expect to see a gold rally and make it a 3 for 3?
There's a possibility because we have the non-farm payrolls data coming out from the US for the month of August in probably the next hour. And if the non-farm payrolls data come out below expectations, that is going to increase the chance of the rate cut even further than what it already is right now. And it may even signal a need for a higher interest rate cut. So yes, it could be a hat trick.
I think we've strategically decided to record videos every Friday because that's when the economic data comes out. And we can take the credit for poor economic data to ourselves and say that gold prices have soared. But anyways, thank you so much for tuning in, ladies and gentlemen. We hope that you've been enjoying this series. And let us remind you that this series is a joint project between us and you. So if you've got any form of feedback for us about anything whatsoever, please let us know in the comments below. And we will make an active effort to get your feedback or to get your comments to come true. Apart from that, if this is your first time watching, welcome. This series focuses on price movements in gold, silver, oil. We also talk about indexes and precious metals and mining equities to supercharge your investing journey. And none of the content that we discuss in this video qualifies as financial advice. And we recommend that you seek a licensed expert if you're on the outlook for financial advice. And so without any further ado, let's get started with the video. And obviously, we talk about gold first. So gold in the US has hit $3,554 US an ounce this week, which is a 3.19% increase, which is the biggest increase that we've seen in gold prices ever since we've started this series, and I believe for a long time as well. Whereas gold in Australia is trading at 5,436 Australian dollars, which is a 3.23% increase. So a slightly bigger increase in Australian gold, which I believe would be because of the weakening of the Australian dollar against the US dollar, as the US dollars managed to strengthen a little bit this week. But let's talk about the important drivers of gold prices this week. The first one is obviously the fact that traders have begun to bet on the Federal Reserve's cutting of interest rates, with the first rate cut since December 2024 anticipated to happen at the September 16th to 17th meeting. And we've also had some notable comments or calls from President Trump where he hopes to see a lower yield on the 2-year bond, which suggests a looser monetary policy. In that we mean suggests a loosening of the interest rates, and a higher yield on the 10-year bond, which signals expectations of increased inflation. Now, in both these scenarios, we see that it's favorable for gold because a lower yield on the 2-year bond does indicate weakening interest rates as well as a weaker US dollar, which could create quite an increase in demand and also cause an inflow into gold as a safe haven asset because it reduces the opportunity cost of holding gold And the second point is, with a higher yield on the 10-year bond, it's a signal of an expectation of increasing inflation. And investors usually rush to gold as a hedge against inflation. So despite the fact that the 2-year bond and the 10-year bond are going in completely opposite directions, which is steepening the yield curve quite a bit, in both scenarios, it's favorable for gold in the short term as well as the long term. Now, moving on to President Trump's comments about the interest rate cuts, the president wants a 300 basis point cut, whereas the Treasury Secretary is proposing 150 basis point cuts. And this is in reference to the long-term benchmark interest rates, which is again favorable for gold, especially if President Trump's basis points is chosen as the move to make by the Fed. Investors are also rushing into gold this week because of increasing concerns about the Fed's independence. We've discussed quite a lot of this last week, where we've mentioned one of the Fed governors being in trouble and called out by President Trump, whose firing was almost certain last week. And as a result of that, investors are now questioning the independence of the Fed and moving away from other assets and shifting to gold. As we also discussed previously at the starting of the video, jobs report or the non-farm payrolls report are coming out today in a few hours, and that is set to anticipate the tone further ahead of the anticipated rate cut. In that, if the non-farm payrolls report come out poorer than expected, we can potentially see a rally coming up in the next few hours. We've also seen ETF buying increase in volume for 7 straight months now, and the Gold Hub projected rate cut probability is 86.4% to 4 to 4.25%. That's our call on what the interest rates are going to be in September 25, which I believe is a 25 basis points cut. As far as silver is concerned, silver also followed suit with gold, but I think silver has made the headlines as much as gold has this week because it's crossed the psychological $40 mark, which is something that people were speculating upon for the longest time, or I believe people were waiting on for the longest amount of time. So we've got some exciting times ahead for silver now that it's crossed the psychological $40 mark. We've not seen precious metals break out of psychological levels, at least for a long time, or break out at the levels at which they're expected to. So I think this is a first in quite a long time, and it's exciting to see what's ahead for silver. So considering these factors, Mr. Brian, we've got ETF purchases happening for gold, increasing in volume for 7 months straight. There's no idea about the independence of the Federal Reserve at this point, considering everything that's going on. We're seeing interest rate cuts. We're seeing the president also favoring a loose monetary policy. We see him preferring a weaker dollar to go about business. What does this mean for gold? And what does this mean for silver now that it's broken the psychological $40 mark?
Thanks for the outline of the market, Ved. Indeed, there is a lot of focus on the precious metals market in light of the concerns about the general economy, the Federal Reserve monetary policy, and the perceived independence of the Federal Reserve, and in light of the comments from the Trump administration. My personal opinion is that the independence of the Federal Reserve is like, while the market would like the Federal Reserve to be independent of the government, let's just say that the track record of the Federal Reserve and most central banks, for that matter, has been absolutely appalling. And what I mean by appalling is they have been given way too much power to run that, to drive the monetary market and also the financial markets. They have become a power unto themselves. In the UK, for example, we saw how the governor had a very heavy hand in causing Liz Truss, the prime minister at that time, to lose confidence in power because the actions by the Bank of England. The Federal Reserve also is hardly independent. It's hardly politically agnostic either. When we saw the actions of the Federal Reserve back in 2015, 2016, when Janet Yellen cut interest rates in late 2015, and then decided it's election year, we're not going to move the interest rate. And as soon as President Trump won that 2016 election, let's raise interest rates, and kept raising interest rates quite quickly into 2017, 2018. Of course, President Trump then managed to put pressure on Jerome Powell not to raise interest rates further, and in fact start cutting interest rates. And also this time round, and also with Joe Biden, where Jerome Powell cuts interest rates 3 times in leading up to the 2024 election in the attempt to try to keep Kamala Harris in office. So independence, it's a good word to talk about, just like telling your child that Santa Claus exists because it makes them feel better. But you can believe in Santa Claus existence at the age of 6 is cute. At the age of 16, if you believe in Santa Claus, then you're naive. And if you're 36 years old and you believe in Santa Claus, you're either a grifter because you're making money out of the Santa Claus industry, or you're batshit stupid. So the market plays along with this, but there are a lot of people who now realize that they can read the writing on the wall. The financial markets are currently spinning out of control because the global economy is weaker than expected. And as much as all the governments say that the economy is growing, the numbers look good, reality of the fact is businesses are losing confidence. Consumers are also not particularly confident, and that's why they need a low interest rates to keep things going. And if productivity remains as it is, we get more inflation, and that's why people are taking refuge in gold and also in asset markets.
Right, and we'll get to the asset markets soon, specifically for precious metals and mining equities. We've got a record breaker there as well, along with gold and silver. But moving on to crude oil. So WTI, which is Western Texas Intermediate crude oil, has decreased this week by 1.32% to US $63.13 per barrel. And the gold oil ratio, as a result, has increased by 0.28 barrels an ounce to 54.49. Now, the discussion around crude oil for the previous 2 episodes has been around tighter supply, and as a result of which we can expect oil prices to increase as well. And I think we also talked about the possibility of tightening margins for precious metals and mining companies unless gold continues its rally, simply because of the tight supply of crude oil around the world, given what's going on. But despite that, oil prices have decreased 1.32% this week, because on 4th September, the U.S. Energy Information Administration, which is also known as the EIA, reported a surprise build of 2.4 million barrels of crude inventories for the week ending 29th August, which reversed the prior week's withdrawal and running contrary to market expectations of tight supply, which we had discussed in the previous 2 episodes, and that unexpectedly weighed in on the prices, because of which we're seeing a decrease now. So any comments that you've got to make, Mr. Brian, about how the gold oil ratio dynamics are right now at the moment? And we're sort of seeing a tug of war happening there between supply and demand in terms of crude oil. And now that the EIA has come up with a surprise build of 2.4 million barrels for the week, have you got any comments on what the future could look like in terms of crude oil supply and how that impacts margins for producers?
It seems like since the Trump administration took office in the beginning of this year, there is a reversal in the attitude of the US administration on fossil fuels, which is spurring greater supply. At least they are becoming more supportive of development and production of crude oil and other fossil fuels in America. And we are actually seeing at the same time they're building the inventory. So while there are talks of tighter supply and then reality seems to suggest otherwise, it's hard to, with all these government forecasts, let's look at, say, economic forecasts and jobs forecasts and all these government administration and the bureaus doing predictions. We've noticed how poor these things are because the bureaus either use surveys or they receive the reports after the fact. So therefore, we are literally, if we're going to use the official data that they report, we are probably 2 weeks to even a month behind. So it's hard to speculate based on these data alone. And I'll probably follow more the narrative from the government and also just watch how the market behaves. But it is clear that fossil fuels is now here to stay. And somehow the US is actually increasing supply somewhere, or there are things that are happening which is causing the data to diverge from expectations. I do expect that the price of oil, in the absence of further global conflict, especially in the Middle East, should remain within the 60 to 65 US dollars a barrel. And that is particularly healthy. I believe that might be the Goldilocks just right type of levels for the global economy to hopefully move in a better direction and be able to accelerate growth and productivity, which is what the global economy needs. It doesn't need just artificial boosts from interest rate manipulation, government talking, and people just getting back to basics, letting natural forces take form.
Right. Thank you for that, Mr. Brian. Moving on with the ASX All Ordinaries Gold Index. We've got a new record this week. Just last episode, I remember we mentioned that a 650 to 700 point increase is a first for this series. And it had also been the first ever since we started publishing even written market commentaries 2 months ago. And within a week, the record has broken itself, and the ASX All Ordinaries Gold Index is up not 7, not 8, but 903 points this week to 13,829.9 points. And there are 3 big forces behind that, I believe. First being gold bullion in itself has gone on a rally. It's crossed $3,500, and that obviously has got a direct link with the ASX All Ordinaries Gold Index as investors began to speculate greater margins coming into the future. Secondly, underlying Australian company news skewed price supportive for mid-tiers and developers. Capricorn Metals is an example. They released their full year financial report on 29th August and showed a 62% EBITDA growth to 273.4 million Australian dollars on stronger realized prices and sales, and also highlighted a materially stronger balance sheet, which is evidence that operating leverage to high AUD gold prices is now coming through the P&L statements of these companies. And Capricorn's not the only one. Oh, Mr. Brian has raised his hand already. Capricorn Metals not. Yeah.
Yeah, just a second. I'm going to interrupt, really sorry. News just in, the jobs data came out and the August non-farm payrolls data showed that 22,000 jobs created. Unemployment rate is 4.3%. And the price of gold, it's a hat trick. It's gone up by $35 US dollars. It's 3,582 US dollars. Silver has gone up by 1.3% to $41.14. So it looks like we did it again.
I'd like to thank Gold Hub Australia for their contribution to increasing gold and silver prices, and also the release of a poor non-farms payroll report. And 22,000 is appalling in my opinion. I think the last time we discussed this in a video, new jobs creation had not been that great as well. Ever since we've started this series, non-farm payrolls report have not been that great in itself, but have been great for gold and silver. But 22,000 is a new low, I believe.
Well, we do have to dig into the nature of the increases and decreases. And, I mean, should we do that quickly? Let me just see whether I can, just quickly check it. Because there's a lot of nuances. Healthcare added 31,000. Social assistance went up by 16,000. Well, this is the thing. Federal government employment is down 15,000. So that's actually the key. Wholesale trader employment is down 12,000. Manufacturing is down 12,000. And even if even if the jobs data doesn't look good, the number of jobs created, it's important to also look at where the jobs come from. The problem with most Western governments is the jobs created are in government, it's in healthcare, it's in education. Now, while it may sound wrong to say, oh, it's not good to have all these job growth in healthcare and education, it's important to note that many Western economies have a bloated public sector, of which health and education are big culprits. It's not that we don't need healthy people, but we certainly don't need to hire those people if it is based on government spending that leads to increase in taxes when you need more private sector growth. So that's a digression. We will just go back to gold stocks, but I wanted to bring this up simply because it was fresh out of the news, and I think our listeners would welcome this information, as well as also realizing that we did it again.
And 23 minutes into the video, I said 45 minutes to an hour, and this happened within 23 minutes. So that's a good one as well. I initially thought it was that I said something so off the charts about Capricorn metals that you had to raise your hand in between and provide your comments on that, like we did for Regis Resources. But moving on, Gold Road Resources has kept the mergers and acquisitions drumbeat alive by filing their interim report on 29th August. They've also posted a lot of substantial holding notices on the ASX, as well as their Goldfields scheme advanced. As we all know, Gold Road Resources is well on their way to make a potential acquisition. And by doing that, they kept the takeover premium narrative alive and supported sentiment around corporate optionality for Gold Road Resources in the space, which is also bullish for the index in itself, given the increased mergers and acquisitions activity that has been happening in Australia specifically with resources or materials companies. And lastly, we've seen capital management and dividend catalysts creating timing effects around that still left the index higher. So what I mean by this is companies like Northern Star Resources and Evolution Mining went ex-dividend on Tuesday, 2nd September and 3rd September, respectively, along with a 5% discount on the dividend reinvestment plan. So what this does is, for example, if Northern Star Resources announced an ex-dividend on 2nd of September, it means that anyone subscribing to their shares before 2nd of September is entitled to a dividend of 30 cents, and anyone doing after is not. And as a result of that, the market priced in the payment of those dividends, which caused the share prices of Northern Star and Evolution to drop just a little bit on the 2nd and 3rd of September, even on the 4th of September, I think. But now that has gone on, the prices of those stocks are back up again. As I've seen, Northern Star is up today. Evolution Mining is up today as well. So dips within that day were visible, and that did cause the index to go down a little bit on the 2nd of September. But net, the index is still up, and it's up 903 points this week. And beyond pure price and stock specifics, the local physical demand data as well has pushed the narrative, in my opinion, because Perth Mint Gold reported August gold sales up roughly 38% month on month, which is a timely indicator that retail and wholesale appetite in Australia is re-engaging into strength. And that backdrop typically underwrites investor confidence in producers is realized premium. And does add to the durability of the rally of not just the index but gold prices as well. And we've done a video on this previously where we've had a guest come up onto Gold of Australia and talk about why he chooses to invest in gold over properties as well. So you should check that video out. It's our most popular video till date. The link will be in the description below. But aside from that, any comments that you've got to make on the ASX All Ordinaries Gold Index, Mr. Brian, because we've also got a specific gold stocks valuation index, which does go hand in hand with the ASX All Ordinaries Gold Index, I believe. And it answers the question of whether gold producers at the moment are overvalued or undervalued or fairly valued. So given that we've seen a rally of, if we add last week and this week, we've seen a rally of 1,600 points. And by next week, it could be about 2,000 points, given all the news that we've got coming along. 2,000 points in 3 weeks. What does that mean for producers? Undervalued, overvalued, fairly valued? What do we think?
Well, if we look at the gold stocks valuation ratio as of the end of this week, we are actually at the highest level in the last 3 years, the highest level being back in April this year when we saw gold rocket up because of the renewed expectation of rate cuts this year. And we're currently sitting at about 84, 85, which is in the overvalued territory. On Wednesday, gold stocks did really well, and then there was quite a pullback on Thursday. And some of these larger gold producers, such as Genesis Minerals, they dropped back like 5 or 6% in a day. I think Pantoro fell by almost 10%, although Pantoro actually was trading at its all-time highs at $5.30. I think $5.33 or $5.34 closing on Wednesday, and it closed yesterday at about $4.85, something like that. And I think today it's recovered. But what I mean is we've reached a point where investors are taking, they're excited about the rally, but at the same time, they are selling into these rallies. Maybe they've been following my appearances on Ausbiz, as I was invited on Ausbiz on Monday afternoon to talk about gold and gold stocks. And I did mention to Andrew Geoghegan, the host of Ausbiz, that I continue to hold the view that the larger gold producers are at least fairly valued, if not generously or even overvalued. So that's why the Australian Gold Fund and the Gold Hub Australia portfolios, we've set some targets to sell some of our holdings for the larger established producers. And we're also suggesting my newsletter readers at Factor Investment Research to do the same thing. We may have taken some of the profits a bit early For example, with Evolution Mining, we started taking some profits and even sell out at about $8.90 back in, I think it was April. I thought I did a really good job doing that. And Evolution Mining's gone up to as much as $9.30, I think. It's closed at $9.06 today, but it peaked at $9.77 in June. Similarly, for Genesis Minerals, we closed out at about $4.80, and Genesis Minerals is trading at over $5.30 right now. West Gold Resources, we advised to take some profit at $2.80, and it's now $3.70. So the thing is, we cannot capture the very top. We don't plan to. But the thing is, my valuation models that we've been working on is been showing overvalued territory for these large producers for quite some time. And we think it's prudent to secure some profits. Even if these companies, as you mentioned, some of these companies are paying dividends and these dividend levels are getting higher. With Northern Star, the final dividend of 30 cents is actually quite significant. Evolution Mining, I think they're still conserving their cash balance for further growth, but they are increasing the dividend quite a bit. Ramelius Resources is also reporting a record dividend for the year. And mind you, companies like Ramelius Resources and Genesis Minerals, they have just been admitted into ASX 100 because their market cap is over $6 billion. To think that 10 years ago, Ramelius Resources was a $40, $50 million company. I still remember that I used to own 270,000 shares in Ramelius Resources when it was trading at like 5 cents, 7 cents, 10 cents. Of course, I sold quite a lot of them. If I'm holding 272,000 shares right now, that would be $1 million. Almost $1 million. I could buy a house with that. But the thing is, just giving you guys the perspective of how much these things can change over time. And it's important to remember that, at least with our business, we want to make sure that we have a good understanding of value. That way, even if the market moves a particular direction, we would choose not to follow and therefore preserve our value and hopefully deliver long-term outperformance.
Right. With that said, we'd also like to remind you that none of the discussions that make it to the video constitute any form of financial advice. Mr. Brian has been quite clear about his holdings as well as the recommendations that he makes to his readers at Fat Tail Investment Research. And these are not to be taken as financial advice for anyone who's viewing this video, except for Mr. Brian himself, obviously. We hope you keep that in mind as we proceed with our next discussion, which is about Capricorn Metals. We did discuss a little bit about it, talking about the contributions it's made to the index this week, but specifically focusing on the company now. Capricorn has put up a genuinely quality year, in our opinion. We're talking a record revenue of 505.9 million Australian dollars, an EBITDA of 273.4 million Australian dollars, which is a 68.72% standardized operating margin, by the way, and making it that makes it the number one company this year in terms of standardized operating margin, which is followed by Greatland Resources, and then the usual suspects. So we've got Evolution Mining, Emerald Resources, and Ramelius Resources, all trading above 50% in standardized operating margin, and the top three, or the top four actually, being in the 60% range. So moving back to Capricorn Metals, just one more additional statistics about their profitability. They've got a net profit after tax of 150.3 million Australian dollars And they finished debt-free on the balance sheet this year, financial year 25, with 355.8 million Australian dollars in net cash, which materially de-risks their growth agenda, which we will talk about soon. Operationally, their Karlawinda project did exactly what you would want heading into an expansion. We've seen volumes through the plant being held up. We've seen metallurgical tweaks that lifted recoveries to 92%, even though head grade, it trended modestly lower, which is at 0.92 grams per ton this year compared to 0.97 last year. But I think that is a fair expectation to have the head grades go lower for producers such as these, whose projects have been around for a long time. Because yes, you can metallurgically improve your processes and you can increase your recovery rates, but it is my understanding that the more you spend time on a specific project in terms of a gold producer, the harder it is to maintain the head grade levels or even the grade levels of the ore that you mine. And we had this discussion for West African Resources in our previous episode as well, where we saw the head grade for, I think it was their underground pit, decrease by, I think, 1 or 1.5 grams per ton. So
I'll just jump in very quickly.
Yeah.
So with mining, it depends on the depth in which you mine the ground. So with Karlawinda at Capricorn, so that it's an open pit mine and it is a high tonnage operation. The grades are actually quite low at less than 1 gram per ton in general, but because it is quite easy to process and the company had built a huge, processing plant for it, it enjoyed economies of scale. Now the grades can actually be, slowly, decrease as they continue mining if they remain within that shell, simply because naturally the company would want to put the higher grade gold first in order to improve profitability. But let's say it digs further deeper into the ground and we get to the underground section, maybe 300-400 meters beneath the ground. Sometimes what makes those grounds economical to mine is that the grades have to be high to justify going that deep into the ground. So it is possible that the grades actually can improve over time, but that also is a trade-off between how far down these trucks have to go and how much harder those rocks become, because as you go deeper beneath the ground, you are dealing with potentially harder rock, and if you can't really get crumbly type of rock in there, because then you're dealing with shafts rather than cutting out, strip mining the area. Literally, you're doing mine shafts, and you need harder rock for that to happen. So there's a bit of a trade-off.
Right. So I believe the takeaway for investors in this case would be to not be too bearish about a company's outlook, especially in terms of their stock prices. If you see a slight decrease in head grades, I think it is quite a common occurrence, especially as a project starts to mature. So despite the fact that Capricorn Metals has done some excellent metallurgical work and lifted their recoveries to 92%, their head grades have trended modestly lower to 0.92 grams per ton, as I said, as opposed to nearly 1 gram per ton last year. The AISC came in at 1,468 Australian dollars an ounce, which is still on the lower end of the Australian cost curve. Not many companies having AISCs that low, which sets up an implied margin of 3,000 Australian dollars for Capricorn Metals, which is ridiculous because that's a margin of 3,000 Australian dollars on a sale price of 4,500 Australian dollars. So everyone at Capricorn Metals is eating good, I think. On growth, Karlawinda expansion project is near-term and tangible. And this is exactly what I was talking about when I mentioned that they've got a 355.8 million net cash position with no debt at all. which materially de-risks their growth agenda. And that was in reference to the Karlavinda expansion project because it's near term and it's tangible. A budget of $120 million Australian dollars has been assigned to add a parallel mill processing or a processing stream, which lifts their processing capacity to 6.5 million tons per annum and target a 25% increase in production to 150,000 ounces per annum. They're currently producing 120,000 per annum, which is in line, which is on the higher end of their guidance. And with this expansion project, the production capacity of the Karlavinda project can increase by 25% to 150,000 ounces per annum. They've got the regulatory approvals to do the same. The key engineering is almost 60% progressed, and they've got their mining contracts in place too. The management at Capricorn Metals describes this execution as a 12-month build, the Karlavinda expansion project. However, the FY26 AISC guidance creeps a little higher. We've seen the strip ratio at Bibra is rising as the pit deepens, which is potentially a lot more costs for the company. And I think that could be a reason why the AISC guidance is higher, because the higher your strip ratio, the higher the amount of waste that you have to get out of the way before you can actually mine and process your ore and extract gold out of it. So higher strip ratios at Bibra, higher AISC guidance as a result for the company in FY26. Their MGGP project still needs full approvals and will consume significant capital. And with the whole Karlavinda expansion project, their Warriedar resources takeover as well as the MGGP project, can sort of set off an integration execution risk, because it's not exactly easy or simplistic to have an expansion project going on. You have another project in development aside from that. And now you're also talking about taking over Warriedar and putting that into the mix. So that is obviously not an easy job. It makes the execution tough. And however, we've got a risk buffer for that, which is their net cash of 356 million Australian dollars. No leverage, strong ongoing operating cash flow, and they've got their put options in place for price protection as well, in case gold prices tend to go down. And they've got demonstrated progress on pre-stripping and long lead procurement as well, which facilitate their project developments quite well. So if we talk about it from an execution standpoint, they've got an expansion project, they've got another project inside of, apart from that, and they've got a potential takeover of Warriedar as well, along with these two projects. But at the same time, given the integration and execution risks of these projects, they've got a lot of cash buffer, they've got no leverage, they've got their put options in place for price protection for the gold that they're already producing, which could create a disparity between their realized and standardized operating margin, but they've done that. And they've got demonstrated progress on these project developments as well without any issues. So I think despite the risks, the risk that exists, the management has taken care of things quite well, and they're going about business quite well. Any comments to make on this, Mr. Brian?
Well, before we started recording, I asked you about which company is similar to Capricorn Metals. Do you remember which one it is?
Regis Resources.
In fact, Capricorn Metals, you could rightly argue that it's actually Regis Resources number 2, because the executive chairman, Mark Clark, was actually the executive chairman of Regis Resources when they purchased the Duketon operations and then turned that into a production. It turned into from a developer to a producer. They did pretty much the same thing this time at Karlavinda as they did with Duketon back then. Large scale bulk tonnage operation with relatively low grades, but the ore in the ground is, I think, quite evenly distributed, and that's why it was a great piece of ground. It was one of the few gold producers where there was very little ramp-up risk when they brought the Karlawinda mine to production. That's why the all-in sustaining cost has been in the bottom quartile. To think that 1,400 Australian dollars an ounce all-in sustaining cost is now in the bottom quartile. 10 years ago, in 2015, a gold mining company that produces at 1,400 Australian dollars an ounce was loss-making because the price of gold at that time was about 1,500 Australian dollars. And you got to add probably about a third of the all-in sustaining costs to include things like depreciation, amortization, admin costs, and also capital used to explore and grow the deposit beyond depletion. So nowadays, there's so much change. Now, I also looked at the company's prospects of the Mount Gibson gold project, which actually is a slightly higher grade gold project with more ore reserves and mineral resources. In fact, Karlawinda currently has about 1.5 million ounces of ore reserves, I think it is. Let me just quickly check. It has 1.4 million ounces of gold reserves at 0.8 grams per ton and 2.2 million ounces of gold resources at 0.7 grams per ton. Mount Gibson has almost 2.6 million ounces of gold reserves at 0.9 grams per ton and almost 4.5 million ounces of gold resources at 0.9 grams per ton. It looks like the company, Mount Gibson, is very well positioned to become to double its production in the coming 2-3 years as it brings that into production. Now, there's a lot going for it. It's also potentially going to buy Warrior Resources if the retail shareholders are unable to stop it from happening. As I said in the previous videos disclosure, I do own Warrior Resources, and I'm putting my stake against the takeover. But I don't own any Capricorn metals. It was probably one of my mistakes because I looked at the grades and I said, the grades don't look great. I did not really delve deeper. So I missed this train. Capricorn metals has increased, I think, 10 times since, I think, 5 years. It's one of the best gold producers. That said, I think the company is generously valued at the moment. Doesn't mean that it won't go up further, but I'm not chasing it at the moment for the reason that it is probably the best one in the market in terms of the operating performance and operating margins. I am looking for undervalued opportunities. I will likely come back to visit Capricorn metals when the gold bull market ends. Gold is cyclical. With the author of a bear market is a bull market, and the author of a bull market is a bear market. So I am definitely keeping an eye on this one, especially with the development of Mount Gibson, and of course the potential that Warrior Resources is added to the portfolio. So that's my view about it. Just like with most of the larger producers, I am cautious about chasing these while they're quite high.
Right. Thank you so much for that. Mr. Brian. And that brings us to the end of the discussion for this video. We'd like to remind you again that none of the contents discussed in this video constitute any form of financial advice. And apart from that, I think we're all done over here. Thank you so much, everyone, for watching. And before we sign off, I'd like to make a suggestion for the title of this video. I think the title of this video should be called "This Company is Single-Handedly Changing the Fortune of Gold Investors, Gold and Silver Investors." And that company is none other than Gold Hub Australia. I think we should make a separate video about how Gold Hub Australia is single-handedly changing the fortune of gold and silver investors. So yeah, that's it from my end. Thank you so much, everyone, for watching, and we'll see you next week.
Well, thanks a lot for that suggestion, Ved. I would like to think that that's something we aspire to, even if we're not providing financial advice to people. Hopefully the information that we provide for them allows them to make better decisions and therefore indeed change their fortunes for the better.
Right. With that said, thank you so much, everyone, for tuning in, and we'll see you next week.
Yep. And ladies and gentlemen, God bless.